There is a massive shift happening in global markets right now, and almost nobody is talking about it. No breaking news alerts, no dramatic headlines, no market panic, but behind the scenes, billions of dollars are quietly moving across borders, across asset classes, and across sectors. And this silent movement of capital could determine what happens next in U.S. stocks. If you're investing in the American market, you need to understand this shift because capital flows drive everything. Prices don't move because of opinions. They move because money moves. For decades, the United States has been the world's primary destination for global capital. International investors have trusted U.S. markets because of their stability, liquidity, and innovation. Companies like Apple, Microsoft, and Nvidia have attracted trillions in global investment. Add to that the dominance of the US dollar and the influence of the Federal Reserve, and you have the most powerful capital magnet in the world. But what we are seeing now is not just money flowing into the US, it's money concentrating in very specific areas, while quietly exiting others. The first major shift is from growth to yield. When interest rates were near zero, investors had no choice but to chase risk. Money flooded into high-growth tech stocks because bonds offered almost nothing. But once the Federal Reserve began aggressively raising interest rates, the equation changed. Suddenly, U.S. Treasury bonds were offering meaningful returns with far less risk. That alone triggered a global reallocation of capital. Large institutional investors began moving funds out of speculative growth names and into bonds, dividend-paying stocks, and defensive sectors. This wasn't panic selling. It was strategic repositioning, and it changed market leadership. The second shift involves the strength of the U.S. dollar. When the dollar strengthens, global capital tends to flow into U.S. assets. Emerging markets become less attractive because their debt becomes more expensive and their currencies weaken. As a result, international investors often park money in American equities and U.S. treasuries. This helps explain why, even during periods of global uncertainty, U.S. markets often show resilience. Capital seeks safety, and the United States is still perceived as the safest large financial system in the world. But this also means that U.S. stock performance is increasingly tied to global currency dynamics, not just domestic economic growth. The third and perhaps most powerful shift is what I call the concentration effect. Instead of money flowing broadly across the market, it is flowing into a narrow group of mega-cap companies. Stocks like Nvidia, Microsoft, and Alphabet are absorbing a disproportionate share of global investment because they are viewed as leaders in artificial intelligence and digital infrastructure. This creates an illusion of broad market strength. The major indexes can rise sharply even if most stocks are barely moving or even declining. When capital concentrates, the market becomes top-heavy. And when markets become top-heavy, they become fragile. This concentration also changes volatility dynamics. When too much money is crowded into a handful of stocks, any negative surprise can trigger rapid sell-offs. Algorithms and institutional trading systems move capital instantly. If bond yields spike, if inflation data surprises, or if the Federal Reserve shifts its tone, large pools of capital can rotate out just as quickly as they entered. That's why we are seeing faster sector rotations than in previous decades. The era of slow-moving capital is over. Today, money reacts in real time. Another important factor behind this silent shift is global uncertainty. Geopolitical tensions, trade realignments, and economic slowdowns abroad all influence where money flows. During uncertainty, investors prioritize stability and liquidity. U.S. markets offer both, but stability does not mean immunity. It simply means capital may choose the U.S. first until a better opportunity appears elsewhere. Capital has no loyalty. It moves where risk-adjusted returns are highest. So, what does all of this mean for retail investors in the United States? First, headline index numbers may not tell the full story. If the S&P 500 is rising because of a handful of mega-cap stocks, that's very different from a healthy broad-based rally. Market breadth matters. Sector participation matters. Small cap performance matters. If only a few giants are carrying the market, risk may be building beneath the surface. Second, bond yields deserve close attention. Yields influence how attractive stocks look relative to fixed income. When yields rise sharply, growth stocks often face pressure. When yields stabilize or fall, risk assets typically benefit. Watching the bond market can give you early clues about future equity moves. In many ways, bonds are the gravity of financial markets. Third, diversification is becoming more important in this environment. When capital crowds into the same popular names, valuations can stretch. And when valuations stretch, future returns become more uncertain. A diversified approach across sectors and asset classes can help reduce the impact of sudden capital reversals. Remember, concentration can drive strong gains, but it can also amplify losses.